Welcome back everyone. We've just finished scanning through a massive wave of insider buying, and we're talking hundreds of millions of dollars flowing into their own companies. From that list, we've narrowed down 6 standout stocks, several of which are not only trading at rock bottom prices, but they're also offering huge dividends on top. Now, if you've been with the channel for quite some time, you know we track insider activity closely because large insider buys are one of the strongest bullish signals you can get. Management only buy for one reason. They believe the share price is in fact headed higher. So here's what we're going to do today. For each one of these stocks we've selected, we're going to break down the insider buying, our intrinsic fair value, and the margin of safety currently on the table. That way we can see, like management, whether we believe these are potentially strong buys right now. So we're going to kick things off at the lower end in terms of the buys with Starbucks, where the director on the 10th of November added just under 12,000 shares, costing him around $1 million. Now this one's been battered down 15% in the last year. Year to date it's down around 5%. And over the last 10 years, well, if you've been holding this, you would have massively underperformed the S&P, only up 41% in the last 10. And we can also see the peak of Starbucks was July 2021, more than 4 years ago, at $126. It is also trading towards the lower end of the 52-week range, quite some way away from 52-week highs of 117, and a traffic light system, sell from Seek Alpha, which is fairly rare to see, a very weak buy rating from Wall Street, 3.63 out of 5, and a hold from Quant that sits at 2.8. Now the forward P does look alarmingly high at 36.3, well above the 5-year average at 28.8, and even though we don't look at valuation models in pure isolation, as we said, we'll put it through our own valuation process, this already looks to be severely overvalued. We notice one of the highest valued in the last 5 years. The lowest point, in fact, was mid-2024, where it was trading around an 18 forward PE. Now, yield does look good at 2.9%, one of the highest on offer, with the 5-year being 2.33. And we should make you aware, especially when we're covering dividends that are fairly high in terms of the yield, and in fact, large disparity from the average. What is the safety score? Now, Starbucks looking at 60, borderline safe, is never something you want to note as an investor. And this is really derived from 2 things. The first one is the free cash flow payout. As always, we do ignore earnings data. It is susceptible to manipulation by management through accounting, although you can in fact note it. We want below 50% for this industry. That ultimately gives us faith they can increase dividends at a very attractive rate. What we have here for 2025 is what we would call a red flag indicator. Now, anytime we notice this at 100% or more, it's telling us that management are paying out more in dividends than they're generating in free cash flow. Yes, it does look better that it's coming down, expected anyway, to 93% over the next 12 months. But what we would say, even if we don't get a dividend cut from the company, be aware that it's likely we won't see fast dividend increases. And the other thing to note that does affect the score is the net debt to EBITDA. How many years will it take Starbucks to pay off all of their debt net of cash on hand? Below 3.5 is what we want to see, so good to note 2.65 and expected to come down over the next year. But as we just saw, their free cash flow payout is sitting at a bit of an alarming rate, so something to bear in mind. And then when we move on to the blue tunnel, which as always highlights the fair value intrinsic price, we're noticing disparity on the upper end. Ideally, we want to see this below the intrinsic value to show opportunity. This, as we've noted for most of the last 12 months, does give us an indication it could perhaps be trading at a premium. And when we zoom out to the last 10 years, well, we don't get that nice forward momentum on the blue tunnel, very rocky, and as we can in fact see, not the first time in this period where Starbucks has traded at a premium. In fact, it did peak, as we say, summer 2021, and also at that point it was at a premium. Now their valuation gets a D+. We've already covered their forward P, which when you compare it to the sector, you're paying a triple-digit premium against their own 5-year average. We already pointed out it does also likewise hit a premium, although much smaller. And if you're someone who wants to look at the price to earnings growth, which really we would say more applicable for the faster growing companies, Anyway, below 2 would get us excited. It is above that and also 64% premium to the sector, only a little bit below their historical 3, so a 5% discount. Now their growth comes in at a D+, grew top line 3% last year, so that is in fact below inflation. When we look at moving forwards, 4.5%, not that great. Again, that's pretty much in line with inflation. Now we do notice the sector overall doesn't have the most growth, around the 3% point, but historically this was one of those companies that did grow in the high single digit. Now earnings per share does look good if you can believe management can execute, projected 13% over the next 3 to 5, above the sector comparative at 10, not too dissimilar from their own 5-year at 13.5. And before we jump into the valuation, well look, over the next 4 quarters, they are projecting 3 of them to be growth, but we should make you aware over the last 4, they've actually underperformed, they've missed expectations 75%, and they were the last 3, so just something to factor in. Historical forecasting accuracy from management hasn't been good, but ultimately over their next full accounting period, they're projecting earnings per share to increase, which will drive the forward P lower to 28.8. Now intrinsically we get to $71, where when we do the deeper dives on the channel, we run through each one of these models, highlighting the inputs and the outputs. Today we want to get through it. We have 5 more other companies to cover. The only thing we would say, if you solely want to look at a DCF, it does come a lot lower intrinsically at $59. Now we've used a growth rate of 8% moving forwards, and you can see based on the 10-year CAGR, actually free cash flow is down 3% on average year on year, and baked in is 12.8% growth to the free cash flow moving forwards. May already give you an idea whether you believe Starbucks is under or overvalued. The other thing we like to do is identify what is the margin of safety on offer. 10% we'd buy, in fact, if it met 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. This is already flagging for Starbucks today. Based on all 3 models, you're actually paying a 22% premium, and whilst Wall Street do severely disagree with us, their projected upside, and bear in mind we did see a weak buy rating, was $95 into next year, 9% upside. If you want to note, at the $71 mark, a 10% MOS would be a buy at $64, at 20 a buy at $57, and 25 $54. But give us your views. Insider buying on Starbucks, do you see it as a buy, hold, or maybe one to completely avoid? Now before we continue, we want to let you know we have released our latest free weekly article covering 3 stocks we're buying in the middle of the AI sell-off. As always, we drop one every single Monday morning to your inbox completely for free, covering severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll be able to gain access to a list of severely undervalued stocks for the month of November. We will be dropping December's copy in the coming days, lots of information for each one, as well as the expected upside that Wall Street project into next year. And on top of that, you can grab a recently released spreadsheet of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. We're then moving on to Energy Transfer, where the director on the 20th, so 9 days ago, added 2 million shares. This cost them $34 million, a huge insider buy. And we can also note here a strong buy from Wall Street, a very respectable buy from Seeking Alpha, although a hold from Quant. And their performance, they've been hit down 16% in the last year. Year to date, they're also down, we're talking 15%. Over the last 10 years, this one hasn't had the greatest performance, but as always, it will ultimately depend at which point you added this company. This analysis is if you added 10 years ago today. For example, someone who bought the COVID lows at just below $5 would be up, in fact, on a very impressive performance. Now, it's also trading towards the lower end of the 52-week range. We can see 52-week high at the $21 mark. And on a forward P to DCF ratio, they're sitting at 6.3. It is slightly above the 5-year average at 5.2. Not the largest disparity from what we saw from Starbucks, but again, potential overvaluation, where the yield sits around the 8% mark, not too dissimilar from the 5-year at 7.9. So on both cases, perhaps you could argue potential reasonable signal. Now we also notice a borderline safe dividend score. This one actually weakened the Starbucks at 50, so we can run through those two different metrics, where in fact on a DCF payout ratio, this is something that is preferred to be used for MLPs. Below 90% is exactly what we see from 2018 quite consistently, and 50% projected over the next year, so no ultimate worries here. And on the net debt to EBITDA, where we want to see below 4.5 for this industry, it's actually been trending downwards, so that is a good sign. 3.82 currently on a trailing 12 month, projected to go lower over the next year, so no massive red flag indicators in terms of this brief review. And when we do take a look at that blue tunnel, we can notice first thing, unlike Starbucks, we actually get to see the blue tunnel, although very slightly, increasing nonetheless, and the price in fact has started to come down a little bit away from the upper end. So again, possible overvaluation, possible soon to be in the reasonable signal. Now valuation, they do in fact get a B. You're talking about a company that's trading at a 9% discount to the sector, but actually against their 5-year, a 27% premium. And if you want to use this for energy transfer, well, price to earnings growth sitting at 1.2, pretty much where the sector sits overall. Now their growth comes in at a B minus. Year on year, it's actually down 5%. The sector was down, but not to that degree. Historically though, they increased their top line around 13% year on year. Moving forwards, projected to be better and above inflation at 6%, also a lot better than the sector at 2%. And earnings per share looking very strong if management can execute, 10% above the sector at 7, and likewise above their historical 6.3. Now over the next 4 quarters, quite an interesting scenario. Each one they believe to be growth, but actually looking back, they've only been in line in fact with one of them, missing 3, and notably the previous 2, something to factor in. But ultimately EPS is expected to increase moving forwards, lowering forecasted forward P to just below 11. Now our intrinsic price gets to just below $23, 22.8. We're talking about a 27% margin of safety. Wall Street very bullish, first strong buy we've seen today, fairly rare to see as well, so we might not get another one in the episode. Just below $22, upside 30%. Likewise, if you want a 30% MOS, well, we're talking around the $16 mark. But energy transfer, very, very large insider buy. Also one with a strong buy from Wall Street, a nice yield around the 8% mark. Is this one that's on your watch list? Maybe you've been buying, or for whatever reason, this industry just isn't for you. Do let us know. We then move on to the Hershey company, where President and CEO 8 days ago added around 2,000 shares, costing them around $371,000. Now this one's up 7% in the last year. Year to date it's up 11%, and we actually notice a very strong rebound from 52-week lows at $140. Still away though from 52-week high at $208. Where we get a triple hold right across the board. Again, that is fairly rare to see. And another high forward P at 30.3, above the 5-year at 25, although we do notice yield 2.9, above the average at 2.1. It did peak in fact just below 4% in the beginning of 2025. Something to bear in mind, but solely on this model, it could perhaps show potential overvaluation. Now for consistency and the yield being at the upper end in terms of comparison to the average, does look good at an 80 safe score. First one we've seen, hopefully not the last today. And then on the blue tunnel, we are seeing it above in fact that upper end, so a potential overvaluation signal. And the blue tunnel has intrinsically come down, although just in the last month, perhaps we are seeing a bit of a turning point. And over the last 10 years, actually this does look a little bit clearer to see what's happened. Around 2024, when we did see the impact of those high cocoa prices, it affected companies in the industry like Hershey, and intrinsically the price has been coming down. Maybe this could be the start of a turnaround play, but do give us your thoughts. Now on a valuation aspect, at a D, we're talking about a company trading at a 94% premium to the sector, 27% premium to their 5-year average. So these are quite high in terms of what you would realistically want to see for Hershey, ideally at a bit of a discount, not something noted. Growth also very poor at an F. We're talking 5% last year, expected to decrease over the next 12 to 2.4, pretty much in line with what we're seeing from the sector and below inflation. Historically though, they do show revenue figures in terms of growth around the mid to high single digits. Earnings per share as well, not something we really want to see. Pretty much expected to be flat over the next 3 to 5 years. 5% is what we're noticing from the sector, and likewise historically from Hershey themselves. Now, in terms of earnings per share over the next 4 quarters, actually 3 of them to be a decrease. The next increase projected far out to Q3 2026, but the first one we've noted with a 100% historical track record, and based on the EPS growth into the next full year, well, forward P forecasted to come down to 27.7. Now, our intrinsic price, $180. Interesting to see DCF comes in above at 208. Where moving forwards, we've gone for a growth rate of 6%. Their 10-year CAGR is 9% and baked in is 4.7. May give you a little bit of an idea of where you see this, but using all 3, which as always, you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, Hershey or any others, does give us a 5% premium. Wall Street, we did see the triple hold earlier, see 190 into next year. That's only 1% upside. And if you wanted a 10% MOS, buy at 162, at 20 buy at 144, and 25 135. But let us know where you believe Hershey sits in terms of that buy, hold, and sell. We then move on to Clorox, where the director, again, we're talking 8 days ago, added 4,000 shares, around $417,000 worth. Now, this one's been obliterated, down 35% in the last year, 34 year to date. Over the last 10 years, first one that's actually down negative 16%. If you'd invested without reinvesting those dividends 10 years ago, let's say $10,000, you'd now be sitting on around $8,400. And we can see ultimately peaked during COVID around at $237, and since then on a bit of a declining trend, trading near 52-week lows, massively long way away from 52-week high, $171. Similar to Hershey, we get a triple hold right across the board. This one, though, unlike those we've covered, is trading at a valuation low, 16.6, 5-year average 25.8, so our first severe potential undervaluation signal. One of the highest yields on offer to investors, 4.6, above the 5-year at 3.2, and good to see a dividend safety score at 70 safe. Now, Blue Tunnel does give us the undervaluation signal. In fact, from the beginning of the year, pretty much this one has looked to be more and more undervalued. The Blue Tunnel itself did dip, in fact, around the September period to only pick up slightly, so no real growth noted there. And over the last 10 years, again, we can really see in terms of the momentum, it is a little bit lackluster, and the share price, as we just discussed, has been coming down from that COVID point in 2020. Now, valuation, B-, an 11% premium to the sector, 35% discount to their 5-year. Remember, this is based on a forward PE. Growth, D+. In fact, the worst one I think I've seen in quite some time. Last year, their top line was down 9% when the sector itself was up 2.4. Historically, that is also what this company achieves. Expected a drop of around 1%. Again, sector projected around the 2.5% point. And actually, like Hershey, this one is forecasting a decrease to earnings per share, negative 2%, when both sector and average of the company sits around 5 to 6. And they're projecting 2 of the next 4 quarters to be growth, 75% track record. Nice to see the previous 2 were in fact beat, and based on a fairly large earnings per share gain from the previous year, forward P projected to come down to the 16 mark. Now, our intrinsic price, $116 from the DCF. We've used 5%, which is above the 10-year CAGR at 3, baked in, pretty much sandwiched between the 2 numbers at 4.2%, and you will notice we're talking about a 7% margin of safety. Well, Wall Street, even with the triple hold we just saw, project $126 into next year. That is 17% upside, where the margin of safety sits at 7%. If you want a 15, well, a buy at 99, which was pretty much their 52-week low. You want to see 20, well, a buy at 93, and 25, a buy at 87. So Clorox, let us know, one of the poorer companies we have covered on the channel, but maybe one you see as a turnaround play. We then move on to Lowe's, where the director, in fact, a few days ago added 1,000 shares, costing him $231,000. Now, this one's down 11% in the last year, year to date down around 2. Over the last 10, it has marginally outperformed the S&P, up 216%, trading around the mid to lower end of the 52-week range. One respectable buy from Wall Street, 4.1 out of 5, with a double hold from Seeking Alpha and Quant. Now forward P sits at 19, a little bit higher than the 5-year average at around 18. In fact, this one's lows was around 12.5, 13. We're talking mid 2022. And the yield pretty much in line, 2 versus 1.9. So both accounts for lows. We could argue this does give a reasonable signal. Now the first, very safe dividend score, great to see, sitting at 93. And we also notice a reasonable signal. It is sitting around the mid to upper end of the blue tunnel, although over the last year, few times it has entered into an overvalued level. And zooming out to the last 10 years, first one where actually we do see some nice upwards momentum over the last 10, although it has slowed down in just the last few years. Currently, as we can see, like it has done for a lot of time, in fact in the reasonable level. Now valuation grading at a D+, 14% premium to the sector, 10% premium to their 5-year. Price to earnings growth 3.61, triple digit premium to the sector, but lower than their historical, so a 13% discount. Growth grade coming in at a D, where we're talking about 1%, not even that year on year. Sector around the inflation mark at 3.5%. That is historically where lows have grown over the last 5. Projected 2.4, again, not great, but look at the sector, not much better at 3.1. And earnings per share, nice to see on the back of the previous two negative, projected 5.5%, but again much lower than the sector at 10 and the historical at 12. But very great to see, in fact green right across the board, 100% historical track record over the last 4, projected growth moving forwards, although not the largest numbers, and we can see forward P estimated to come down to 18.6 in Jan 2027. Now our intrinsic price $267, although solely on a discounted cash flow, we are talking we've used 5% where baked in is 4.4, and the valuation does come in a little bit lower. Bear in mind though, 10-year CAGR does sit higher at 9%, so you could argue we have in fact been conservative, but using all three models at 267, you're getting a 9% margin of safety. If you want 15, well, a buy at 227, at 20, a buy at 213, and at 25, around the $200 mark, around their 52-week lows, and Wall Street 278 into next year, 15% upside. Maybe you like this company, maybe for Home Depot, or none of these are companies you want to touch, do let us know. And then we move on to the very big one, DoorDash, where in fact on the 26th of November, so we're talking just a few days ago, we noticed the director adding 514,000 shares, costing him just over $100 million. Now this one has been up 10% over the last year, year to date up around 18. Over the last 6 months though, we can see in a downward trend over the last year, down 24. In fact, it is trading right there towards their 52-week lows, where we get a very weak, and that is the bare minimum needed for the buy rating at 3.5 out of 5. Very respectable buy from Wall Street, 4.4, would need 4.5 to flip that into a strong buy, and Quant do give it a hold at 2.8. Now valuation, they get an F, forward P 39, which means a 123% premium to the sector, but historically it's sat very high, meaning you're getting an 86% discount. But if we look at the price to earnings growth for a company, as we're about to show you, is one that fits the growth criteria, 0.6, well below the sector at 1.7, so a 65% discount. Things could get very interesting for this company moving forwards. Now growth A+, year on year up 25%, well above the sector at 3.5, but we do notice in fact the 5-year of the company much higher at 72, so growth is slowing down. Their forward-looking growth rate, 27%, again faster than last year and above the sector, which is a good sign. And they're projecting earnings per share 64% year-on-year over the next 3 to 5, well above in fact the comparative of the sector at 10 and their own historical at 31%. So looking very good and nearly green right across the board. Firstly, projecting double-digit growth over the next 4 quarters, 75% in fact outperformance, and those were the last 3 quarters. And we can see based on the EPS of the next full accounting period, forward P comes down to 31.4. Now our intrinsic price, $280 from the DCF model. We've used 15% moving forwards. Baked in is 9.2, although you can see if you believe 10, we're talking single digit upside. If you believe 20, well in fact a near double. So using that middle rate, we actually see 30% margin of safety, Wall Street, as we pointed out, a near strong buy rating, $285 into next year, 44% upside, one of perhaps the better looking companies where we saw the largest insider buy, so let us know if you'd like a deeper dive. And for those that want to be more conservative, well look, at 10% in terms of the growth rate moving forwards, you are getting a margin of safety, but it does sit lower at the 5% point. So let us know with DoorDash whether you see this as a strong buy or maybe one to completely avoid. And don't forget as always to sign up to the free weekly newsletter, grab those spreadsheets, come and join us at Patreon where we cover our buys and sells. And as always, have a great day. We'll see you all on the next one.